Investors are going crazy for Spanish government bonds and a low interest rate, loose monetary policy environment in Europe. But analysts have warned that the rally in peripheral Europe's sovereign bonds could come to an abrupt end if the region's sluggish growth rates and worryingly low inflation levels don't pick up. So why do investors keep flocking to European bonds? With us today is Tal Keinan, CEO and co-founder of investment management firm Clarity Capital. Mr. Keinan, thank you very much for joining us.
Thanks for having me.
So give us a little background here. How is the political instability we see in Europe reflected in the markets?
Right. So look, I think in the big picture, the situation in Europe is bad,
right,
not catastrophic. And I think that's a key distinction. So we do have obviously, political and economic instability at the periphery. We have, the events of the summer in Crimea, Ukraine. Certainly the kind of sky-high unemployment rates in Southern Europe, particularly in Spain on the one hand.
Right. On
the other hand, we have a cohesive Europe, which is being backstopped by the European Central Bank, and that's been a critical factor. So that if you look over the summer, we've had declines in equity prices in European markets, but also in other markets. It certainly hasn't been a crash. I think we're probably down, peak to trough, maybe a little over 4% in European equities, which is not a big deal. And as you alluded, yields on Spanish government bonds are actually lower than on U.S. government bonds today.
So on that note, why are the yields so low, considering the high unemployment rate that we see? Right. Clearly the Spanish economy is a high-risk economy.
Well, so I look at it like this: sovereign bond prices, or in the inverse, sovereign bond yields are a reflection not only of credit risk, but also of inflation expectations. Credit risk really only starts becoming a factor when things are extremely risky, or we think default is a maybe not imminent, but likely scenario. Right now, inflation in Europe looks like the farthest thing. I mean, deflation is certainly the more frightening prospect for the European economy. The ECB is on a loosening trend, whereas the Fed is already on a tightening trend. The Fed has tapered its purchases of securities, and the next step is to lower interest rates in the United States. To raise interest rates in the United States. Right now, we see interest rates going down. Probably in Europe are certainly staying stable today. They stayed stable, but the trend is certainly not to raising rates. So as long as Europe remains cohesive, meaning the ECB is still backing the European periphery, I think we'll see a similar scenario in European bond yields.
Right. So, in light of the economic risks in Spain, Italy, in Greece, are the low yields on Spanish bonds sustainable?
Okay, so here's what I'd be looking for. There is a kind of a central scenario where eventually economic momentum starts picking up again in Europe. I don't think that's imminent, unfortunately. I think Europe is in a true depression. Certainly Southern Europe is in a depression. I mean, the numbers are similar to the U.S. Great Depression of the 1930s, certainly in terms of employment. And we're not really seeing GDP growth, certainly in Southern Europe, even in Europe as a whole. When we do, and I think it is a question of when, it might be a why, when we do start seeing economic recovery and inflation expectations come back, then we will see bond yields move. The other scenario, which is more dramatic, but in my opinion far less likely, is some sort of serious credit event. So something, for example, that points to a dissolution of the European Union, which again I don't think is in the cards.
That seems quite a dystopian future.
That's right.
Perspective. And how does this relate to the bond markets in the U.S., the bond market in Israel? How would you draw this comparison?
Well, okay, so the U.S. is really the converse of that. Is the U.S. economy is truly in recovery. It's what we call the jobless recovery for a long time. Now even the employment numbers have begun picking up in the United States. The Fed is nearing the end of its tapering program. So the next step, I think in 2015, we're likely to see actual rate hikes at the Fed. So that's kind of bad news for U.S. bonds. It's obviously not a reflection of credit risk. The United States is a very low credit risk. I think that's what that's about. In Israel, I think you see a different story. Israel's looking a lot more like Europe in terms of kind of again, we do print our own money in Israel. We don't, unlike Spain, we are not beholden to a foreign central bank, so to speak. So we issue most of our debt in local currency. So the default risk in Israel is quite low. That said, inflation expectations and economic growth expectations has really come down over the last year. So I think that's why we're seeing Israeli bond yields starting to look more European than they have ever, probably.
Well, it'll be interesting to see where they go. Thank you so very much, Tal Keinan, CEO and co-founder of Clarity Capital investment management firm. Thank you very much.
Thanks.